See, as Indians, we love buying things at a discounted rate, isn't it? I mean, we love bargaining. Even when we buy vegetables, we love asking for that 5 rupee dhania for free, right? I mean, we always want to pick things at a lower price. We wait for discounts. The same applies to stock market as well, value investing. We have that fascination towards buying stocks at a lower price, right? I mean, that's value investing. But that becomes a challenge in the market cycles like this when markets are expensive or in the perceived that, okay, that markets are all-time high, how do I pick value style stocks? To discuss on that, we have Mr. Anil Rego. I would like to welcome Mr. Anil on the stage. Please welcome, sir. Let's welcome him with a big round of applause. To introduce Mr. Anil to all of you, Anil comes with almost 3 decades of experience in the capital markets. He runs a organization, a group of entities called as Right Horizons, where they handle multiple products. Portfolio management services is one such thing. He's a portfolio manager. He's an educator. He wears multiple hats, and then he's really created wealth for Indians in the last 3 decades or so. So welcome once again, Anil.
Yeah, thank you for your kind word.
You're known to be a contrarian fund manager, right? Contrarian, would love to understand from your perspective, you can put it in a very simple way. What is contrarian approach? Does it simply mean buy the stocks which have been beaten blue and black? Or what is contrarian approach? How does it work?
Yeah, so I think as the word says, you're going against the market, right?
Yeah.
And most people think, yes, I just have to do the opposite. Okay, yeah. If market is going up, okay, I will go and
you go sell it.
Sell and vice versa. Actually, a true contrarian, should be able to, at the lows, when you switch on television and everything says like, okay, this bank is not going to survive, one of your top banks, the industry is in shambles, there's war. You can hear a lot of that right now, right? And through that, to have the conviction to be able to say, yes, I want to go and buy this company. I want to go and buy this stock. Okay, I want to invest into the market right now. So I think it's about how we are able to go against the tide. It's not just about doing things blindly opposite of what other people are doing.
Okay.
Go against the tide and be a lot more disciplined. Okay, because that is what helps. So, some things that I do, for example, is I try to switch off from, say, markets and news that comes and hits me.
Okay.
And I like to do the research myself.
Okay.
Okay, that allows me to sort of go against and have my own point of view.
Sure.
Because when you're bombarded with information all over,
yeah.
right, then you feel. Again, I'll give you an example of maybe COVID.
Yeah.
Right? At that time, I think a lot of customers, also good friends, they also came and fought with me saying that, no, why are you suggesting that we buy right now? And, at one point we said, go all in. Okay, what's wrong with you types?
Yeah.
My point was going back to data.
Yeah.
Right? So even if I went back and studied data on, past epidemics.
Yeah.
Right? It's again always in waves.
Yeah.
Right? And earlier you didn't have medication like you had today. Yeah. But even then you had the spike like that and it fell down. Even before all the vaccinations could come, nothing.
Yeah.
Right? So nature has its own way. So if you study data, if you look at it, from your perspective, look for numbers. Okay, then I think you'll be able to take a decision which is away from what people are doing. And at times, like I'll give an example. On the other hand, we took a contrarian call somewhere in March and said we gave that a view that 20% return on the index for this financial year is what we expect. Okay, and we also said that mid and small caps are likely to do better.
Oh,
okay. That time everything was going wrong.
Yeah.
Right from, if you went and saw the US had its banking crisis and, India, you had the Adani issue, you had FIs are pulling out money big time and small caps were falling the most.
Yeah.
Right? So So that is, that at that point of time, sort of, we went and gave a buy call. We followed up. We actually came out with a small cap fund. And then, interestingly, from April to August, we saw a 45% return.
Wow, okay.
Okay, absolute 45%.
Absolute, okay, wow, okay. That's,
Right?
yeah.
And then suddenly a lot of people came back and some customers came, you know what? 45%, should we not get out?
Okay.
So the point I'm making is just, you cannot just do the opposite, right? So the worst thing to do is, because our data shows that typically a small cap rally is a 3.2x, which means 220%, okay, and about 2 years. It's not a short term, right? Not 5 months, not 4 months,
Okay.
right? Even if and the run has always been steep.
Okay.
Okay, so I'm just giving an example that yes, both sides, it may tempt you to do the opposite,
Okay.
but you have to hold your ground, look at data, and then take calls.
This sounds very interesting and also intriguing because when you get your calls right, it feels, like let's say, I'm sure you would have beaten the underlying benchmark in a big margin and all that. You did give us an example of, like let's say, taking that equity call and all that. Can you give us some examples of last 2 or 3 years at right horizons? Some of the contrarian calls you could have taken from an example's sake, not from a, again, recommendation. Probably that would help us to understand, okay, this is how practically it works.
I'll give 2 examples. One is on the overall, from the market side.
Okay.
Right, I gave you the most recent one.
Yes.
Okay. Interestingly, and at that point of time, we didn't see so much of noise, right?
Yeah.
If you saw October to December of 2019, right, the Nifty PE was running 28, 29 times.
Wow.
Okay? That time everyone was bullish.
Yeah, it does.
Okay, prior to COVID. Okay, and interestingly, we took a call that, just by data, it didn't make sense.
Yeah.
Right? So from there, we have one of the portfolios that we handle is called FlexiCap. It gave us flexibility to move around, right? So what we ended up doing is we took a cash call on it.
Okay.
Okay. We also moved out from financials. Financials that time was almost hitting 40% of the index.
Index, yeah.
Okay, so we moved out of, again, a big contrarian call, moved out of financials. We got into pharma. We also, so we did some of those things, right? And of course, even on our wealth side where we advise customers, we did a profit booking. Okay, got out of equity, got into debt, did systematic transfers back. Okay, so that is something that, so at that point of time, we came out. And in my view, if it was not COVID, it was something else.
Yeah.
Okay, because markets, like somebody said, how can you say, this time COVID will be is different, right? We've not seen something like this, at least in your lifetime. Okay.
Oh, yeah.
Right? So, but every time for markets, it's always different.
Yeah.
Right? But how market reacts, the emotion, the fear, the greed,
Yeah.
right? They are all the same. The people, the crowd,
Correct.
right? So we track those indicators. So that, apart from, let's say, looking at just simplistic thing like the P, then we sort of pulled out. And interestingly, FlexiCap was one of the best performing funds in COVID fall, right? So 2020 March. Okay, so there are cases like that. Now on stocks, for example, I'll give you, like there was a paint stock, Sirca Paints, where there was a fire in their factory.
Oh.
Okay. Now the stock fell, I think, some 17% or so. And typically, most people would got frightened and say, yeah, now next 3 years or 2 years gone because it takes so much of time, right? But we went back and we studied data. I mean, that time you go deeper.
Yeah.
Okay, so the point is when you're taking such decisions,
Yeah.
you have to always go deeper.
Yeah. And should be backed by data.
And data, and take decisions based on data, right? So when we went that, we said that, okay, we went and bought. Okay. We had some bit in the portfolio, we went and bought. And it was maybe a 4-bagger for us from there, right?
Yeah.
So if you are able to take those calls, that's my point. If you're able to sit through all of this, difficult times, fear, and then say, okay, this is a hidden jewel, right? And this is the basis for it. I'm not just thinking, it's just a,
Okay.
I have thing backing it up. So both, like I said, on the stock
the market
level,
call and the stock level
Yes.
call, what you're like. So, coming back to the topic, what we initially introduced, so when we talk about value, the idea is to buy stocks which are undervalued. From a retail or an individual investor point of view, mostly we look at PE ratio as the standard measurement factor and say, okay, PE ratio is low, stock is undervalued, let's buy, PE ratio is high, stocks are expensive, let's sell. Is that all? Or what are some of the parameters you think we could look at for determining, okay, this is undervalued or overvalued?
See, we have almost 10 different strategies, and one of them is a pure value strategy. And yes, the bigger search is for value, right? But broadly, our approach is that we want growth at a value, right? So, and that's a more difficult one. So you actually look at companies which are growing, okay, and then say, yes, but out of these ones which are growing well or likely to grow well, which of them are at a reasonable valuation? Okay, so that is sort of something that we believe much more strongly, because a country like India inherently is a growth country. So if you go back and try and maybe for some of the more developed countries, you can really go and search for value and stuff like that. There are points when value will really spring back, and we saw that in some recent times. There were companies which just doubled, tripled in just some period of time. It was just that it's like a spring sometimes. They're compressed value, and then sort of, the spring gets released, right? So I'm saying it's not as simple as just saying, let's look at P ratio and stuff. Okay, so what we do is, again, Anupam also had that thing that, we follow a process. We follow different 4 Ps. Okay?
Yeah, okay. Nice, okay.
Okay, we have 4 stages of our process.
Okay.
Right, so that's the, almost like each journey of it is a thing into a process. So what we do is we first make it more difficult for ourselves to invest in a stock. Okay, because it has to hit all the parameters, right? So once it happens, then, once it's difficult for us, then we say, okay, now within this screen that we have, now how do we start tracking them? Then go deeper and stuff, right? So I think it's a lot to do about being able to first assess the growth. That's why while you're saying that, value, I'm saying first assess growth.
If you were to just simplify and say, when you say undervalued, not necessarily just undervalued companies, but one is growth potential, that definitely. Just maybe 1 or 2 parameters for, like, you would say, okay, these are some of the value indicators.
Yeah. At a very simplistic state, you have, typically, people say, like today, okay, the market is overvalued. Okay, or they say, market is all-time high. Actually, all-time high is, it's always going to be at an all-time high because it's an index and the EPS will keep growing and stuff like that, right? So there's no relevance in absolute things, right? So interestingly, PE also has become a little bit like that.
Like that, okay.
Right? Okay. That you are only looking at value. Okay? So you have a price PEG ratio today which has come.
Okay.
I'm saying that can be closer to what we are looking at. But apart from that, when we look at it, we look at actually doing your cash flows, doing a valuation.
Okay.
And based on that growth, we are coming back and saying, sometimes is this, even a 40p, is it justified from the future growth potential? Or, and that today, we will look at future valuations, as of a year from now, 2 years from now, and take some of our calls based on that, so that it's not just, looking at pure just PE ratios. It's like looking at the balance sheet, the cash flows, all of it, what the company is likely to do, and versus that, looking at valuations. PEG can be one simplistic way of doing it, but we go deeper in terms of also doing the valuations.
So I've got some interesting statistics about the super value PMS portfolio, what you run. So it has delivered more than 25% CAGR returns in the last 5 years. I think that itself is a commendable achievement. And it is also, holds about 28 stocks, like let's say top 5 stocks where you have given about 30% weightage. Top 5 sectors accounts for about 70% of your portfolio. Somewhere it also feels little concentrated from the general layman point of view. So some of your sectors or industries include manufacturing, consumer goods, financial services, metals and healthcare. So these sectors in the next, let's say, I would say 6 months to a year or so, what is the outlook for these sectors? Because there's a concentrated bet into these sectors. What's your outlook there?
See, I think a 70% type of thing on at a sector level, top five, I think is not too bad. Okay.
Okay.
So I know of funds who've done very well, including on the small cap side, which 70% will be even the top 7 or 8. Right?
Okay.
Okay, so that is there, and that also has a particular style, right? The thing is that you put your weight behind the winners, or what you have the highest conviction for.
Correct.
Today, let's say Warren Buffett and all prefer something like that, right? So, but we still, I think we like to find a line between over diversification and under. So I think we are somewhere there. And when we're having 28 stocks, it's a large number.
Yeah.
Okay, for a PMS. Okay, the mutual funds definitely sometimes they have crazy numbers.
Yeah.
Okay, so from that standpoint of it, we are not. I'm just saying we are not as diversified. But at the same time, you have to have your conviction. For example, one of the reasons is we may be a little underweight on say technology. Okay. So and we are sort of waiting for putting our weight behind say manufacturing.
Okay.
Right. So, and within manufacturing also you may find 2-3 sectors there. Again, if you look at financial services itself, the index also has a very high weight. Right. So if you go and add up some of these, you still have to have your conviction behind them. Okay. And our views, all of these, we believe the future is sort of the core sectors, manufacturing. So a lot of them will actually come within that. Right. And I think that is the theme for India today. We believe India will do very well in this decade and hopefully in the next. Okay, so that's the whole point of putting your money where your mouth is.
No, that's very interesting. Yeah, I agree with you to great extent that a PMS for a PMS 70% need not be that concentrated. I mean, from someone who's seen mutual fund portfolios point of view, it might look concentrated, but okay. So coming to the stocks, the story of the stocks, I think one of the key holding in Right Horizons portfolio is KEI Industries. I think that has done phenomenally well for you. It has generated about 560% kind of appreciation in the last 5 odd years. So when did you buy this stock? It's a very interesting story to know. When did you buy this? Do you still think that there is potential for a company like this which has grown 5-fold or 5.5-fold in the 5 years?
Yes. So first of all, you came to a stock, so then disclosures, unfortunately.
Yeah.
So we hold the stock,
Yeah.
right? So and I'm not necessarily giving a buy or sell recommendation on it, right? So, but just more from a learning standpoint is what one captures, And this is important. I think I want to maybe also share while you invest yourself, right? You need to look for good multi-bagger returns in your stocks. Yeah. Okay, and the worst thing ever if you say, okay, you know what, this stock gave me 70%, let me take it home and go away, okay, and I lose the next, 500%. Okay, so it's important for us to be able to, continue to track and see how we are going forward and, doing well on some of that. Okay, so KEI specifically, something in 2019. So it's been some time, okay? But definitely a good multi-bagger in that period of time. Again, it's not like I held it for 10 years.
Okay.
Right. So that has been the case. In fact, our search is to try and see how we can make finding multi-baggers as a process. Okay. And in the last almost 3 years, I think we have almost 20 multi-baggers.
Wow.
Okay.
That's actually commendable. 20 multi-baggers in such a short span of time. It's quite unheard of.
And what is it that? So I'll spend some time maybe on what is it that you look for. So rather than this stock.
Yeah, makes sense. Yeah.
So you can do. I think the point is about how again you are able to go and look into the company, go deeper, right? If you're able to, and the trick is, are you able to find an emerging leader? Right? And KEI was not the number one. Okay, you had Polycab, which was there.
Yeah.
Okay, and so we chose to go with Polycab. Also is a great company. We hold it in some of our
Polycab also
other-
has done well. I mean,
Yeah.
it's not that they've
Yeah,
not done
I'm
well.
not saying, yeah, definitely. But KA, we specifically chosen some of these portfolios
Wow.
because we found it as an emerging leader. Okay, a lot of it, fundamentally when we went and searched, we liked it. In fact, many of the smaller companies, we also go and talk to management, understand and stuff. Okay, and then that, we look at it. So my point is, can you look for companies which are likely to see a re-rating? Okay. So one is to say, okay, what do I think the earnings growth for this company is going to be? If, for example, the earnings growth I think is 25% per annum, right? You can broadly say stock price follows that, right? But if on top of that, if there's a PE expansion,
Okay.
that's where, you get the money.
Acha.
That's where it goes beyond just 1x, it goes 2x, 3x, and the number of companies like that.
Basically, you've set that process for those multi-baggers.
Yeah.
So, interestingly, there's one more interview where you had mentioned in the month of May, you were bullish on mid and small cap. In fact, that kind of played out well as well. Do you think there's still juice left in the coming period for mid and small cap?
So I gave that example. So actually, I think right from March, like I said, we actually came out with an annual report where we said, we took this contrarian call, right? And we followed that up. There were one or two things that it happened, it started moving and people came to us. And we said, yes, we continue to be bullish. So when we are talking about April, May, it was a continuation of a stance that mid and small caps are likely to do well, okay? So that is something which, is a multi-million-dollar question, okay? And Anupam said, right, I don't know.
Yeah.
Okay, so I call it astrology. Okay, so when you're trying to crystal ball gaze as to what is market going to do in the short term, okay,
it's very
it's very difficult.
I agree with you.
But at the same time, again, like I said, looking back at data, right? If I look at, let's say, a 3-year growth in earnings versus, let's say, a 3-year growth in the small cap index, okay? The biggest gap, and the gap is that earnings has grown much faster than stock price growth in these 3 years, is in the small cap today, even after the rise.
So you mean to say the earnings have grown faster than the price itself? That's basic fundamentals itself should justify the...
Yeah, so many people, I think, in this noise, right, have missed it out, right? So this is the whole point. How do I step back, look at numbers? How do I see, okay, today, is the market at a high? I don't think so. Your P ratio is somewhere closer to 20. 2021 is actually a buy, right? There's a lot of information, noise, things. So let me look at it this way. So if I see downside, how much do I see? Right, in worst case, let's say, maybe a 15%, but look at the upside, right? Typically, you'll find that P expansion goes right up to 28 again. And not only the P expansion, in that period, there's also growth in profits. Right? So you put both together, it's very interesting. So I still think that we are at a very interesting phase. Yes, there is going to be volatility. There's always going to be noise. We are concerned about the US actually and interest rates, and we are very negative on we had a negative view because whichever is the country of the decade, typically sees pain for the next 2 decades, at least.
Okay. A country of a decade sees pain for next 2 decades.
China was the country of the previous decade, is in its 2nd decade of pain, and it's not over. Wow. Right? Japan had almost I think 3-4 decades.
Three decades of pain already,
Right? So I'm just saying that because what happens, fundamentally if you see, when things are going really well, okay, people take a lot of risk and you have a lot of indiscretion happens, NPS are getting built up, right? And that's where, so we call that a leveraging cycle. People take more loans, get more risky, right? And after that what happens, you have a period of deleveraging, and that's the most painful one. When companies say, I forget about my profit growth, I've had so much of pain with my bankers, my first priority now, I have to go to zero debt. That's it.
Repay.
Right? So no fresh thing. And that's a many of them thinking of that together. Like we saw for real estate, right?
Yeah.
All real estate companies said, no, you know what, I mean, I had terrible times, sleepless nights, people chasing me, so I want to play safe. And so that's, a little bit of what we should look at.
That's a very interesting thought. In fact, yeah, I think this one thought is going to stay with me. One interesting decade for a country will be, like let's say, accompanied by 2 decades of pain.
That's why I said we expect India to be the country of this decade.
Yeah.
I said also, I hope next
Yeah,
decade.
in next decade. Wow.
But I think there are certain fundamental factors which hopefully go for us longer.
Long.
And it's our demographics, very low age. If you look at it versus, like, say, the US saw its baby boomer phase. Almost 15 plus years of secular bull run.
Yeah.
Right? So post that. So we have things that are working for us right now, which hopefully will stay as good.
So I'm sorry, I'm quoting a lot of your interviews. I mean, because some of these have been really interesting, and I could really pick up some of these pieces from there. In one of the interviews, you had mentioned if there are 2 industries which you're really bullish on, one is on banking, other one is on building materials. And that too, when we say building materials, we are talking about plastics and metal pipes, paints and adhesives, and etc. So why are you bullish on this space? And then also, what's your view on the HDFC merger, the big twins merger?
Yeah, so I think financial services for a country like India is definitely going to be a very core part. Yeah. Typically, financials and consumer has always been great for India, right? Because of a great consumer market. Yeah. So I think that is something that will sort of continue. And my point for why financials, if you go back and see, actually India saw a deleveraging decade last decade. Okay, was a deleveraging one. That makes us even more bullish, right? And because if you remember, at that time there were 4 AAA rated companies which went to default, overnight.
Yeah.
Okay, and a lot of companies, also saw the pressure. You had one of the debt mutual funds which really saw, had to be supported, and then you had all the others which were in limelight, right? And they all got beaten down. So India saw that deleveraging. We expect now to a leveraging decade to happen because all the NPAs are gone. You'll probably have write-backs. PSUs are doing well also because of that. Okay, because all written off. Now suddenly some NCLT resolution happens and their money comes back to them, which was written off, right? So that, and fundamentally there's a growth thing. Also from a consumption side, I think like real estate, etc., we believe will sort of come back. There's already people building houses of their own, apart from, say, real estate companies. So building materials, and and within that we chose like pipes and stuff like that, which are, we felt were, we were not too comfortable going after real estate companies itself, because there's a whole lot of, issues around, the whole cash economy and, is it good, is it bad and stuff like that. We said, let's go for the underlying, okay, so it makes it safer. So we chose that, as a thing. And your HDFC Bank, again, some of that is at stock level. So I think broadly HDFC Bank, I still believe, has a great engine, okay, and that's what they've built over the years, and see consistent growth. I don't see that engine deteriorating per se, okay, but definitely as size goes bigger and bigger, their ability to grow at the same pace will always slow down. But yes, in the short term, see, typically when there's a merger, right, the first will be a period of slight pain. Putting it together, people also internally also irritated, everything happening. Everybody thought it's more rosy than, because whenever people look at a merger, they all look at the, good side of things. Yeah. Okay, then the bad sides start coming. And after that is where the actual growth comes in. It comes in. And if you are able to do the integration, etc., properly, it will come in, right? So I still think that in the long term, it may be a good thing for the company, okay, but in the short term, there's still be, some bit of that upheaval because, they have to integrate and, that period, a slightly painful period.
The last question is, every time we speak to the experts, rightly so, people are gung-ho about Indian economy, Indian markets, etc. And then we are fundamentally strong and growing. But at the same time, when you look at two-wheeler sales or passenger car sales, that is not really growing at the pace what is actually expected to be growing. So is still a fault line somewhere in the overall growth story we are talking about? Are we still looking at only some section of the society recovering, some section still left behind? What's your take there?
So I think we spoke about, right? If you want to buy a car today, will you get it immediately? The Mahindra one?
Yeah.
Yeah,
The waiting is still on, yeah.
Right? I have had colleagues who, waited for 6 months to get their Toyota stuff, and not only Indian, everything, So part of it was, there were supply chain issues, right? And there was a period of downturn, right? And it typically happens. You'll go back and see, this market has its way of, correcting and, getting things back. The automobile sector was overheated. It was really doing well for a good period of time.
Yeah.
All Marutis now really kept on going up, Bajaj Autos, all of them, did extremely well. Okay. And then you started Eicher Motors, okay.
Yeah.
Phenomenal
That's
rallies,
it, yeah.
right? So some of them did extremely well, okay. And then market has its own way to, then somewhere Eicher Motors from having, whole booking period and stuff like that, suddenly you saw them, coming down, right? So that is something which markets has its own natural way. And then once you have a downturn, everybody becomes cautious. If they were about to set up a factory, they'll say, no, let me put it aside for some time and stuff. So that also creates some little bit of supply side constraints, right? Because they're not seeing that growth. And then suddenly growth happens, right? And that's where, prices go up and then you have waiting periods and all of it. So I think still, because it's not yet back to normalcy, so I think that inherent little more can come up. It's only supply side issues which we are having, which also is impacting there. So I'm saying at a broader level. Sure. At a two-wheeler level, for a stock picker, okay, there's difference between do I make money on a stock, okay, and does the industry do well?
Industry versus
like the whole, if you see the retail, right? It really went up, but maybe Amazon and Flipkart did well, and companies like that, right? So it was not everybody. So I think the two-wheeler thing has become a little bit of a lot of electric vehicles have come in, and that's a little bit driving growth, right? And if you go back and see, I mean today it's almost people just put a motor in, something which looks good design, and you have it going. So in some form, the technology has become that much more simpler for people, and we see that is not a great thing for companies. If you're buying the stock. So we want to be a little more cautious on the two-wheeler segment, okay? And that's something I said a few months back, maybe a year back, okay, that we are not so comfortable because of this, right?
Okay.
On cars, I still think that technology is not yet so easy to put together. Maybe over a period of time, we'll have to wait and watch. But so that is, I think, there. But it's a little bit of supply side. But broadly, I think automobile is also growing. It may not be at the pace that it could have grown because of supply side. Again, and we're not bearish on it. We think it'll deliver a stable one. But it's not like suddenly, because today maybe the volume, the scale is already there, right? It's something which is just emerging suddenly. Can you double?
Can double?
Those will not happen. But a good, stable, strong growth is something that we think will continue.
Great. Thank you very much. You've answered all the questions patiently. Is it okay if we take a couple of questions from the audience?
Sure.
Yeah.
So my question is that you have said about picking up value investing. Two things you said. One is the earnings growth, and second one is that P expansion. So earnings growth is something that can be predicted or modeled. How about this P expansion?
Yes, so I think if you have a company which is not too small, right? Too small, then first it has to get discovered, and then it has a thing. If it's somewhere, the second or third in line, it's growing well, say there's capacity coming in and stuff, I think broadly it also gets recognized, okay? Because some reason why the P expansion happens also is when institutional investors come in, right? So it is, if you've done the first one right, okay, and you looked at the valuation of your second one, you'll probably do well if you're also figured out that this growth is likely to continue.
Which means if the company comes in the visibility, then PE expansion comes.
Yeah, but it also happens naturally, because from being undiscovered, when institution comes is where you really see a big one. That's where if you see small caps, for example, at times they can be really ridiculously low in terms of P ratio. Of course, the other extremes also happen, because then there's small floating stock, right? So suddenly at a whole small cap level itself, you may find the P ratios go even to 50, right? So those are cases which are there, but if you want to look at sustainable ones, see, the other point is you may find something really in periods of boom, right? And small cap rally really happens well. You may find that stock run up fast, crazy, but when the fall happens, also it falls down crazy. So it's about, if you're able to also look at the cash flows, how consistent they are likely to be. Okay, that's something which will sort of also ensure that you don't see those downs, and then you can buy a stock across cycles, right? Which then the P ratio happens, the recognition happens, the institutions buy, and then sort of it does well.
Correct. Got it. Thank you, sir.
Yeah.
Yeah, as you mentioned, investing in small cap would give more return. So, what's the ideal portion? For example, he or she doesn't want to take much return, much risk. So, if a person wants to allocate some percentage in small cap in portfolio, what would you suggest? What would be the ideal portion? Like percentage would you suggest?
Yeah, so I think it's a very, very good question, because what happens is at times like these, we suddenly see customers' portfolios, and even when it goes on TV shows, and when the types of fund names that come in, suddenly you'll find either everything large cap or everything small cap. Okay, the first thing is a discipline of saying, okay, how do I look at risk, and how much do I put, based on my risk appetite, right? So there's no simple answer to that. You would say 15% I cannot give you, because I have to understand your risk profile. If you are a person who can take risk, then you do it higher, but you do it lower. But if you cannot take risk, then you don't even invest. For some of my senior citizen clients, I tell them, peace of mind, just leave it, why are you bothered? That return will keep going up and down, it's okay, it doesn't make a difference. Anyway, because for them then the stress, right? If it actually falls, then suddenly they're worked up and stuff. So I'm saying, first look at risk. Okay, once you've looked at risk, then to say at certain times you can increase. Maybe it's slightly complicated, but if you're able to understand valuations and relative valuations, in fact, how do we, like in our flexi cap, move between large cap and mid cap? Again, we go based on data, based on numbers. Okay, so we look at what is the past valuations of small caps. If you're able to do 10-year valuations, what is the valuation now? Okay, if the 10-year valuation is higher, that's the time that you can put in more money. Okay, if the long-term average is higher than the current one. If it's vice versa, then you have to start becoming careful. Okay, slowly keep reducing. I believe for a person who can take, say for a 30-year-old person, I would still not put 100% of money in all. Okay, so I will still do maybe a smaller thing, large cap. I think a great category is a flexi cap or a multi cap, where then the fund manager takes care of that moving, right? Then you have a mid cap, and then you come to a small cap. And I would think something like a 15 to 20%, 25% for somebody who can take high level of risk is something you can do. But otherwise, either stay away or be somewhere in between.
And last question, what's the right age to start the investment, according to you?
Okay, so I'll give you my story. Okay. I started investing into markets for my second PUC days. Okay. In fact, I wrote a book as well, Honey, I Lost All Our Money, in story form to try and educate people. Okay. So the thing is, the earlier you can do, the better, right? And the world is flat. Okay, today, especially, okay, even in Chennai maybe, but we are from Bangalore, and a lot of people, what they do, you go and give them a recommendation, they do their own research before they even say yes. It's great. Okay, we'll come back and tell, okay, why have you suggested this fund? Value research is saying this is a 4-star fund. It's not a 5-star fund. Okay, it's good to do. Of course, some of it is also experience you need to look at. Sometimes a 4-star and at times even a 3-star fund is great to do because you're talking about future. So 5-star may be for the past. What you think of the future is, if for example, if you think a value is likely to do well in the future, then I will not look at the rating as much, right? So that is something that you keep going and doing, rebalancing all of it, and in some form that's a journey. So coming back, earlier the better. Compounding is great when you start early. You can take good risk when you're starting early. Most of the time, your parents are covering you for your expenses, hopefully, okay, or you are covering yourself, okay, but learn, okay. It's a thing that you start learning. In fact, what I tell people sometimes when you're starting, right, even do virtual, okay. I encourage my clients to give money to their children to invest. I tell them start small, okay, don't give beyond a certain point, because they have to learn on their own. You have to lose money. Only then you'll know what investing is. And you will lose money. Even though I was, earlier itself I had a multi-bagger strategy. In the Harshad Mehta time, I know the exuberance that was there. I was forced to invest 500 shares in a single company because they said, you cannot invest 100, we are not taking it anymore. Okay, that company became zero. Right? The good part is there were 9, 10 other things which did well, which covered up for it. Okay? But the point I'm making is, it's a learning journey. It can only happen with experience. Sometimes this whole thing of wave of getting carried away by markets, how can you get away from emotion? Okay, if you're able to stay away from that, if you're able to think away, okay, everybody is gung-ho, right? Can I stay away? Okay. In fact, I do the opposite, right? As soon as everybody is running after me, like customers say, why don't we buy? Investors are coming to us, I say, it's my first warning signal, right? When they come to me. When I have to go to them, I know markets are right. And they say, no, let's, let's sell, let's do this. I don't want to invest now. I know that's a buy signal, okay? So those are things that if you're able to start training your mind to think differently, to think long-term and to look at it as a journey, not get a high, right? Because markets give you a high. You'll make money, you'll put more money, you make some more, you'll put more money, and then the fall happens. And the falls are always vertical. We've not yet seen, I think most of us have not seen the 60% fall. And 60% fall from the peak, right, is a much larger number. So 100 going to 200 rupees, went up 100%, but a 60% fall means it fell 120, it's below my par, right? So that is something that we should keep in mind. 60% falls are going to come back again. And if you are ready, and with cash, that's a perfect time to buy. You will see multi-baggers and you will make fantastic returns.
Thank you. Thank you, sir.
Thank you very much. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.